Hey, what's up guys? My name's Adam and welcome to the video. In light of recent events and potentially future events, a lot of people are uneasy about how their investments are going to fluctuate. Just this week, we've seen stocks like Apple and Amazon hit their all-time highs, followed by sizable losses across the board as concerns over the illness reignite. Emotions are running high and can take over, which can cause us to make mistakes. I want to show people the other side, logic and reason.
Reason will prevail. Reason will prevail!
Anchored in cold hard facts to hopefully sway you from making an emotionally charged decision which could cost you a lot of money. But first, before we get started, don't forget to gently tap the like and subscribe button down below. Petting the YouTube algorithm is good for its overall health and happiness. It's quick and free for you, and it really helps me a ton. With that said, let's get into some very good reasons why you should keep calm and stay the course. The first point that I want to remind everyone is that you don't actually lose or gain any money until you sell. Think of it this way. If your holdings spiked and then returned to normal before you sold, you never actually had that money in your possession to begin with. Those gains were unrealized. On that same note, if all of your holdings crashed, but then recovered to an even higher rate before selling, you never actually lost any money, and in fact, you actually gained money. If you're a day trader, you're in a different boat, but for the rest of us who should be mostly long-term investors, this works to our advantage. We have the most valuable resource in the universe on our side, time. Since we are investing long-term, we will not need the money for at least 2 to 3 years. We can ride the wave of whatever ups and downs the market experiences, knowing that it will eventually bounce back and climb even higher. Let's take a look at the 2008 financial crisis, which is one of the worst crises our economy has seen. The Dow went from around 13,000 in January of 2008 down to about 7,000 in March of 2009. This is the span of a little over a year. From here, it only took 3 years until March of 2012 for the Dow to get back to its level of 13,000 again. And right now, even through all the turmoil, it's still sitting at around 25,000. Similar story for the S&P 500. It was around 1,500 in the beginning of 2008 and slid all the way down to 750 in March of 2009. It got back to 1,500 in February of 2013, just 4 years after bottoming out. And now it is sitting at over 3,000. 3 to 4 years is really not that long in investing time, and this period was also followed by the longest bull run in history. The people who panic sold all of their holdings at the bottom lost a lot of value, both immediately and on future gains that they could have made. Plus, what else are you gonna do with that extra money? At the bottom, the damage is already done and you can only go up from there. If you take all of your money out and put it in a bank account, even with a generous interest rate of like 1 to 1.5%, you're actually going to hemorrhage money even more. The average inflation rate in the United States has been around 2.17% over the last 20 years. If you're not getting at least that much, that 2.17% return on your investment, whether that be interest, stock price growth, dividends, or whatever else, your money is still losing value due to inflation. Now, I get that some people have no choice but to sell. Maybe they were retiring or lost their job and had to cover their expenses. I'd advise selling as little as possible if you absolutely have to. Like many others say, you should only invest money that you are willing to lose. A different way I like to think about it, money that you will not need to touch in the near future. This is why it's best to build up an emergency fund that will cover 3 to 6 months of living expenses, then start investing money after that. This way, you're not forced to make choices that will cost you money later down the road. So to bring home the first point, you don't actually lose money until you sell. If you have been investing for the long term with money you will not need anytime soon, it is better just to ride that wave back up. Bonus points if you can invest during the dip. As Warren Buffett said, be greedy when others are fearful, and fearful when others are greedy. And remember, millionaires are made during recessions. So the second point is that time in the market beats timing the market. There have been several simulations of theoretical investors putting in their money at the absolute best times, the absolute worst times, and steadily over time. The most accessible and digestible one, to my knowledge, is the one posted on Reddit by, I'm gonna butcher this, but /u/Jerschneid? Whatever, I'm gonna put it up here. It even has pictures to go with it so you don't have to read too much text. I'll leave a link to it in the description below. I highly recommend looking at it yourself, but I'll give you the SparkNotes version of it. There are 3 friends with 3 very different investing styles who started their investing journey about 40 years ago. They each saved $200 a month for a total initial investment of $96,000 for each of them at the end of the 40 years. They all put their money into the same S&P 500 index fund. So first of the 3, we have terrible timing Tiffany. She has the absolute worst timing possible, saving up all of her money just to buy at the highs and sell at the lows. Even with horrible timing, she ended up with over $660,000. That's not bad for a worst case scenario. Second, we have buy the bottom Brittany. On the other hand, she had the absolute best timing. She saved up all of her money and bought in at the exact bottom of each market crash. And she of course profited as the markets recovered. She had impossibly perfect timing. No one, not even the professionals running million-dollar hedge funds on Wall Street, can do this. So compared to Tiffany, she of course saw much higher gains. No surprise there. She ended up with around $950,000, but remember, this was with inhumanly accurate prediction. Finally, we have slow and steady Sarah. All she did after setting up her investment account was also set up an auto investment payment of $200 a month. That's it. She was basically hands off for the entire 40 years. She ended up with almost $1.4 million. This is around 45% more than Brittany, who timed the markets perfectly. How is this possible? Well, buy the bottom Brittany missed out on all the smaller but much more frequent gains between the periods of economic crashes and subsequent recoveries. Let's take a look at another example. Right around the time the dot-com bubble burst, we saw almost a 50% loss here. So let's flip over to the laptop screen real quick. So Steady Sarah had been investing in all of the years leading up to the peak, most notably around 1990 to 1995. Just to keep things simple, let's say she bought in once in 1990 for a price of around $300. By 2007, this would have been worth $1,500 for a net profit of around $1,200. So now let's take a look at bottom Brittany's strategy. Wow, I should really read my scripts out loud before filming. She buys in after the market has fully crashed. So she buys in the year 2002 for around $800. By 2007, that would be worth the same amount as Steady Sarah at a price of around $1,500. Brittany missed out on all this growth from 1990 until the bottom of the stock market crash while she sat on her cash waiting to time the market. This is only a profit of around $700 compared to Sarah's $1,200. That's a $500 difference. And again, it's not possible to have bottom Brittany's perfect timing. So if you take this and multiply it out over thousands of dollars, the difference in real life is actually going to be quite a lot more. This is why you should invest consistently during the ups and the downs. There is plenty more literature to prove that time in the market beats timing the market. The last point I want to bring up is a quick one about your tax liability when you go to sell investments. Assuming you've made money on them, which you hopefully have. When you go to sell these, you will get a tax bill later, which can hit you pretty hard. Whatever profits you made on selling is going to be taxed at either the short-term or long-term capital gains tax rate. For single people, the short-term tax rate is the same as your regular income tax rate. Long-term is 0% up till $40,000, then 15% up to $434,000. For married couples, it's the same for short-term, but for long-term, you're paying 0% all the way up to $80,000 instead of $40,000. So do your best to hold on to investments for at least 1 year before selling so you can enjoy the lower tax rate. Let's say you bought a stock for $500 and sold it within a year once that stock price reached $1,000. This is a $500 profit. This sale invokes the short-term capital gains tax. The average tax rate in the United States is about 24%. Well, let's just say it's 20% just to keep things nice round numbers. At the end of the year, instead of pocketing the $500, you actually only get to keep $400 of it because Uncle Sam needs to collect his freedom dues. Now, let's say you sold thousands of dollars worth of investments for a total profit of $5,000. You're only going to see $4,000 of that because of taxes, and maybe even less if it bumps you up into a higher tax bracket. That's over $1,000 of your money that you're just giving away. This is especially bad when you think of the opportunity cost versus leaving your money in while the markets recover. Not only are you now losing money because the stock prices are down and you'll have to pay taxes on the sale, you're also losing out on future returns from when the stock market recovers. This is another solid reason to hold on to your investments. You probably don't want to be hit with a giant tax bill right after economic turmoil. That's it for this one. Thank you for watching, and I hope this convinced you to stay in the market if you were thinking about selling. Also, feel free to come back to this video during the next financial crisis, because I will probably have the exact same advice. Just remember, you don't actually lose anything until you sell. Time in the market beats timing the market. And if you did sell, you'd be hit with inflation, capital gains tax, and opportunity costs to further amplify your losses. Don't forget to pet the YouTube algorithm if you want to see more of my content. It's quick and free for you, and it helps me out a ton. I'll see you in the next one. Take it easy.